Well, hello everyone. I hope you've had a great weekend and a great start to your week. It is Monday night, and I thought I'd take some time to make another video and just share a little bit about what's going on in the economy, some things with interest rates. I'll cover a few topics, but I've had a number of emails from people from the last video, and so I just wanted to take the time to obviously just keep sharing with you, give you some updates, and really probably the thing that I want to convey the most is the purpose of these videos is really just to help people understand what's going on. There are a lot of opinions and ideas and talking heads on the TV giving you different opinions, and maybe I'm a talking head tonight, but the goal for me is to give you some real practical tips, some good understanding of what is going on and how you can position yourself best at this time. Now I'm wearing my green polo tonight, which I don't wear very often, but it was a great day in the stock market today. I'll show you some stuff in a little bit, but this is green is good, green is money, and so I like to wear the green one when we've had a good day. But there's a number of things that I want to share with you tonight. And, the most important thing is to not panic and to not make rash decisions. And that's what I see people do all the time. They see something happen, they freak out, and then they make a quick spur of the moment decision. And at the same time, I've seen the opposite. I've seen people just sit and just wait. They don't take the time to understand what's going on. But at the same time, sometimes you need to act decisively. So, it's both. Sometimes you shouldn't knee jerk and just react to the news. But then at other times, you need to move and to do something. So the idea is to give you as much knowledge as possible, as much understanding as possible, so that when the time comes, you can take advantage of it and you can make those right moves for you. And so I want to talk about a couple of topics tonight. So I'm going to share a couple of things with you. I've made a few notes this way we won't forget anything. And so a couple of things, I'll talk about the economy, I'll talk about supply versus demand, I'll talk about unemployment, interest rates, inflation, stock market, and real estate. And hopefully those things will cover some of the main things. So let's talk a bit about the economy. And here's something that a lot of people don't understand is how the economy works. And I'm going to give you an economics lesson. You can find that anywhere, but just some very, very simple things for people to understand. And this is going to sound basic, but if you get this, then you'll be able to track what's happening with this coronavirus and the slowdown and obviously the economy coming to a standstill because of the lockdown. So the first thing to remember is that the economy is really just transactions between people or between companies. It's really the exchanging of goods and services for money. Okay. And when the economy shut down, obviously everyone stayed at home. There was no exchange going on. Nobody was giving people anything. No one was buying. I mean, obviously, unless you're buying online. But generally speaking, the bulk of the economy had stopped effectively. And so that slowed down all those goods changing hands, all those services being produced. Now, as we start to reopen the economy, the thing to remember is that all these companies that were producing goods before are not producing them at the moment and haven't been producing them. I mean, take the car manufacturer. I mean, all the car manufacturers stopped. Obviously, no one was buying cars. But, the car manufacturer makes a certain amount of cars per day. Ford will pump out thousands and thousands of cars every day. But out of those thousands, you have to think about it. Some of it will go to inventory to dealers. Some they're selling. Some they're keeping for other reasons. If it's a new model or something like that, they've got a supply chain of places they're going to, whether it's a rental car agency, whether it's a dealership, whether it's a leasing company, whatever it might be. So all these different people that are buying from Ford, their demand is known. They know we sell this many cars per day, per week, per month. And so they order, and then the factory is producing that number of cars. Well, right now we've shut down. When the economy starts back up again, and this is true of anything, not just cars, obviously all the cars or all the meat well, meat's probably not a good example because, people still been eating, but any products that have not been sold during this period, and a lot of them haven't been sold, a lot of those products have not been made for the last 1, 2, 3 months. And those that did have the product inventory that were selling, what do you think they've been doing? They've been dwindling that supply down. They're not going to be boosting those numbers up because they don't know if they'll be able to sell it, especially if it's something that has a use by date, food products and things like that. So effectively what's happened is all these different suppliers have reduced the amount of inventory that they've had. And some of them are way down to zero and some of them are very low levels. But people aren't maintaining huge amounts of inventory right now because they don't know if they'll be able to sell it. So what do you think is going to happen the minute that the economy opens up? And I know we've started to reopen, but really it's going to take a bit of time. They're going to have huge amounts of demand relative to the inventory they hold. So if if you're producing shoes right now and not a lot of people are going shopping, a lot of the stores are closed, what you'll see is a bunch of people turn up to the stores wanting to buy shoes. But when everybody wants to buy at the same time, the factory will not be able to produce enough. And so there's going to be shortages of these products relative to the amount of people that want it. Look what happened with toilet paper and hand sanitizer. I mean, take toilet paper. About 50% of toilet paper is retail. In other words, it comes to the consumer. You buy it for your home, Costco, Safeway, Kroger, and so on. But about 50% of it is commercial, so hotels, apartment building, not apartment buildings, but like office buildings and things like that. So it's commercial toilet paper. So the challenge that they had was they couldn't quickly change all the supply chains and the factories and everything to make the toilet paper for consumer demand when the demand for the hotels and restaurants and all that died off. And that's why we had a shortage of toilet paper, because more people wanted it than what the factories could produce. Because during a normal situation, I mean, people aren't going in and hoarding toilet paper. And so because of that, the amount of supply that they produce each week, each month is enough for the demand. But when that demand came and outstripped the supply, there was a massive shortage. You're going to see that happen with a bunch of things over the coming months. And I'm not saying go out and panic buy or anything like that. But what I am saying is that a lot of these supply, and probably food services and things like that, a lot of that is going to be okay. So we're not talking so much about food and things like that, but there'll just be other goods in society that take time to build and make. And from the time when the government allows them to open up and start to make them again, it's going to take a while for them to build up their reserves, number one. Number two, they're not going to want to build their reserves up as much as what they did before because they're not sure how many people are going to buy. And then lastly, the people buying may not be able to afford to buy as much or pay the prices they were paying before. So there's going to be a significant adjustment in the economy over the coming weeks, months, and maybe years, who knows, of this adjustment period. And just remember that the people that are working in these companies, these are employees. So the company, if they're only producing, 20%, 30%, 40%, 50% of what they were producing before, they're not going to need 100% of the staff. You're only going to need 20, 30, 40, 50% of the staff to produce that. So the thing to remember, or the thing to understand during this period is a lot of businesses are going to ramp up slowly, even if there is demand, because they don't know what happens if they start producing enormous quantities of goods, and then we get what they call a W-shaped recovery. In other words, we kind of start to go up, and then there's another lockdown because coronavirus gets worse, and then we have to lock down again. They don't want to be stuck with all that inventory. So a lot of companies are going to be very cautious over the coming period as they're producing goods, and they're not going to want to overproduce. So, the way that things are going, in my opinion, there's going to be a slow, gradual growth. Now, of course, there's going to be some industries that take off and do really well, but on the whole, I think the economy is going to take some time. Whether it's a W, and hopefully it's not a W, but whether it's a W-shaped recovery or whether it's a kind of a U-shape or an L or whatever, a lot of companies are going to take their time. And because of that, I believe that the economy is going to be depressed for a period of time, because it doesn't matter how much money the government throws at it. It doesn't matter how much the stock market goes up or down or sideways. The reality is these companies cannot produce as much as the demand is in the market at any one point in time when it all comes at once. And many of them will not want to produce those elevated levels because they're not sure if they can be sustained. And what that will do is put significant strain on those employees in those companies. And those employees are the ones that go and spend the money in other companies. And so you're going to see unemployment persist for a period of time because of these factors. And so just remember that even though, yes, the government's throwing money at the economy, and yes, there's a lot of things happening to try and spur it on, and interest rates are coming down and all that, we'll cover some of these things. But just remember, you can't buy what's not available. And companies are not going to overproduce or even produce at the previous levels until they're sure that they're out of the woods. And that's going to take a period of time. And so why am I telling you this? Because we have to understand that the people that are saying that things are going to bounce back really, really quickly, yes, it could bounce back quickly for some things, But those are the things that were relatively unchanged throughout the crisis. But the things that got hit really, really badly are going to take some time to come back up. So just understand that process and react accordingly. If you're an investor, if you're an employee, whoever's watching this, think about what the impacts are going to be in your industry, in the things that affect you. Did you stop completely? Did you just reduce? How much did you reduce by? Because a reduction from 100% of capacity to 80% of capacity can be a lot easier to make up than one that's 100% down to zero. Okay, so it's going to take time to ramp that up, and a lot of people don't understand this. So as much as, I want to see the economy return and go really, really strongly, and I think it really will. I think, my view is that in the next kind of 6 to 12 to 24 months, don't know the time frame, but within the next 1 to 2 years, the economy is going to boom. I believe that we're going to see an enormous amount of growth. And that's why I'm positioning myself at this moment to take advantage of that. But more of that another time. But the point is that right now we are going to go through a protracted period of slow growth, and very little growth until some of these things stabilize. Because normally when you have a recession or you have some issue in the economy, you have one part of the economy that drops, but the rest are okay. This is everything just stopped overnight. And so it's going to take time for those things to ramp back up. And they're not going to all go like this. They're going to go like this, and maybe some a little bit down and then back up until eventually we're back to where we were. And so it's going to take a period of time. So it's just important to remember that. And so that's something that most people don't talk about. They don't understand the ins and outs of those things. But hopefully this has been clear in explaining those transactions between people and companies, how it's going to affect the workforce, how it's going to affect companies in the products that they make and how many they make and how much they can sell them for. Because all these things feed into basically income for people. And income is really, and spending is what drives the economy. So there's going to be a protracted slowness. That doesn't mean doom and gloom for everyone, but it does mean you need to be prepared for that. So let me share on the next topic, and that's really unemployment. So unemployment's hit about 36 million people. It's 14.7% as of the end of April. Okay. We had 3.5% unemployment before this coronavirus hit. So basically 3.5% unemployment's gone to 14.7% unemployment. And there's a forecast of 25% unemployment, by the time this thing is finished. Whether that's true or not, whether that happens, who knows? It's just one of the forecasts. But the thing to remember about unemployment is it's very, very quick to come up. It's going to take some time for it to come down. And the reason why is for all the things that I've mentioned before. It will take some time for all these companies to hire back all those people. And the real risk with this piece is that the government's obviously helping people. They're giving companies money. But when it gets to the point when the government just can't give anymore, there's just no more money to give, or it's not possible to continue the same level of spending if the economy doesn't pick up. That's when we're going to see some wobbles and some issues. And so that's something that, is maybe for another video, but it is something that can happen. And like I said, we had huge unemployment spike very, very quickly, but it's going to take some time for it to come back down. And that coming down is people not spending, people not going out, people not investing, people not, because they're afraid, because they can't, because their jobs aren't there, and they're uncertain about the future. Okay. So that is something to keep in mind at this time while you're reviewing your positions and what you're doing, whether it be real estate, whether it be stock market, any other investment. Just remember that these are people at the end of the day. All these, when you see unemployment numbers, yeah, I get that they're numbers, but these are all people. They have lives, they have homes, they have families, they have dreams and hopes like all of us. And so in the same way, they're considering their future in a post-coronavirus world economically. And they're thinking to themselves, am I likely to get my job back? And if so, when? Because that's going to determine how much I spend, whether I spend, what I spend on. And so these are things that are going to have some drags on the economy for a period of time. And you need to be aware of those as you chart your course investing. Okay, the next topic that I'd like to talk about is interest rates. And so I'll just touch on this quickly. So some people have heard about interest rates going negative. And this has been done in Europe. They've looked in Japan to do this. So there's different countries and regions that have tried it. So far, the Federal Reserve has resisted and has said that they're not interested in pursuing negative rates. And effectively, negative interest rates mean that it costs money to put your money in the bank. So, and really it's for institutional companies more than anything. The idea is that the government wants banks to lend, But, sometimes banks are afraid. And so instead of lending, they just keep it in there. And so the government wants to charge them to deposit their money into the bank, so that instead of losing money by depositing into the bank, what they're really saying is go and lend it out, because that way at least you can make some money. It is a very, very strange concept to many people, having negative interest rates, but it is something that's been done. Do I think the US will go down that way? I don't know. I think it's possible. And if that happens, that's going to have further ramifications for the economy, and especially for banks. Banks are going to really get hit hard if that happens, because it's very difficult for them to make money in that environment. So I won't touch on that more than this, but just be thinking about that, as part of your investments. Be listening to the rhetoric from the government, from the Federal Reserve, about whether or not they are open to doing negative rates. It's not the end of the world. Like I said, other places have done it, but it does have a significant impact on the economy. And it hasn't really been shown to have enormously great effect, because ultimately, look, people don't want to borrow money if they're afraid, if they don't have a job. Their biggest concern is being able to protect themselves and their families. And so, yes, there may be very cheap money to be had, but if you're afraid that you can't pay it, because remember, when negative interest rates hit, we're really talking about the Federal Reserve rates. We're not talking about the rates that get the people borrow at. So you'll still be borrowing at positive rates. It'll just be that those institutions will be paying negative rates. And so, people don't want to borrow even at 0.5%, even at 1%, if they don't believe that they can afford to repay. So that's just something to keep in mind as you go through this process. Just be listening to what people are talking about, because that will be a topic that will come up more and more over time. The next one I want to talk about just quickly is inflation. Now, inflation typically is 2 to 3% per year. Inflation is really just the erosion of the value of your money. $100 today doesn't buy what $100 bought 10 years ago, and it doesn't buy what $100 bought 20 years ago or 30 years ago, right? We know that money loses its value over time. And a lot of people say, well, inflation is basically, zero at the moment. Prices, have been stagnant for a while. Inflation's been low. Go to the store, go to the supermarket, and buy some eggs, buy some milk, buy some veggies, meat, and you tell me if in the last 2, 3, 4 weeks, the prices have not gone up. Okay, prices have gone up. And the reason they've gone up is because you will pay it, because you have no option. Okay, the supermarkets will price their products at what people are willing to pay. And number one, people are at home, so they're cooking more. They're not spending money at restaurants, most of them, unless they're getting some takeout. And so people are cooking more. And so their food bill in some ways has come down, because obviously eating at a restaurant is typically more expensive than eating at home. And so because of that food bill coming down, restaurants have increased their prices. Why? Not restaurants, supermarkets have increased their prices. Why? Number one, because they can. Number two, because the producers, the people that are making those products, have increased their prices. Why have they increased their prices? Number one, there's increased demand. So again, they can, right? They can charge you more and you will pay more. Number two, their costs may have gone up, because they may have less people working. They may have to pay overtime in order to get even more products out there. So all of those things we're talking about are feeding into the system and increasing prices. And so you're paying more. Well, guess what happens when you pay more? Your purchasing power is reduced. If you could buy eggs for $2 before and now they're $3, you can't buy as many eggs as you could before with the same, $100 that you had. You will buy less product over time. And so don't listen to people that tell you that inflation is not happening. It's not an issue. Inflation is absolutely real. It just doesn't happen to you, where you can always see it. But go and try this out. Go and have a look. If you haven't been to the store lately, go and have a look at the price of eggs and milk and meat and so on, and you'll see it is more expensive than it was 2 to 4 weeks ago. And I believe that whether it stays at this level, or not long term, it will never go back to the level that it was before. Because you know what happens psychologically? If you're paying, $2 for eggs, and for a while you've been paying $3, they may not go down to $2, but it might go to $2.50. And you think, wow, it's a bargain, right? Why? Because you're used to paying $3 for a period of time. And then you say, well, you know what, $2.50 is a bargain. And that's how prices go up. You get used to the higher price. And then when it comes down, you consider it a bargain. But when you look back and go, hey, but I used to pay $2, right? But it's the same with gas. It's the same with housing. It's the same with anything. All these things increase over time to where today we say that that's a bargain. But, 10 years ago, it wasn't a bargain. Right? So psychologically, these are the games that these companies will play. And honestly, they're not doing anything wrong, in the sense of they're just trying to maximize the money that they can make. But just watch for that. And that's why it's important. I've said to people in all the seminars we've done and anything that I teach, saving is for suckers. I mean, long-term saving, short-term saving is fine. but long-term saving is for suckers because you stick your money in the bank and they give you basically nothing for it. And, then your purchasing power is eroded over time. Money moves. You have to do something with it. You can't just hold on to it. You can't stick it under your mattress. You have to do something with it, or else your purchasing power, the amount of real money that you get to keep over time, will erode by 2 to 3% per year. And honestly, in times like this, it could be even higher. So just keep that in mind. It's an important point. Don't lose sight of it, because people that do will be sitting on a lot less money over time if they don't take this into account. So inflation is a big one, whether or not people realize it. All right, last two topics for this evening: stock market and real estate. So let's talk about stock markets. Today was a crazy big day in the stock market. The S&P 500 went up, but in particular, the most important thing to note is that nothing really changed in the economy overnight. What happened though was the Federal Reserve Chairman Jay Powell, he made some statements on 60 Minutes. Okay. And I won't get into statements, but he made some statements that encouraged the market. But here's the interesting thing. Last week on Wednesday, he made some statements, either Wednesday or Thursday, and the market completely tanked, okay? People didn't like what he said, and the market crashed that day. Well, people loved what he said on 60 Minutes, and the market shot up. And look, it was a good day, okay? Don't get me wrong, I'm not unhappy, but it is crazy how much the market can change because of something that one person says. And if he says the right thing, it's great. And if he says the wrong thing, it's terrible. And so today, so this is my portfolio in Robinhood. Today, my portfolio went up 15.48%, about $10,000, a bit over $10,000. This was in one day, okay? That is insane. That is insane. It makes no sense. Okay. I mean, I'll take it, right? That's why I'm wearing the green shirt, but that makes no sense, right? 15%, over 15% in one day. Let me show you what's happened with the airlines. I own a number of airlines. I actually sold some today. But here's what happened today. Check this out. United went up 23.85%. Spirit Airlines went up 28.34%. Southwest, I've got a bunch of stocks in Southwest. I had some Delta today. I actually had Spirit, and I had, that's it. I had Delta, Southwest, and Spirit. So I sold my Spirit and my Delta, but I'm holding on to Southwest. I like them. So the point is this: these companies went up 20 to 30% in one day. That is a crazy change. I mean, you're talking about companies going up 2, 3, 4, 5% per year. Maybe 10% per year in crazy times. For a company to shift in price 30% a day is enormous. Look at the banks. The banks went up crazy too. Wells Fargo, so number of shares in Wells Fargo, not a lot, 8.7%. American Express, 7.35, 7.65, and so on. Okay, crazy increases. Some other ones. I had some GE stock today that I sold. GE went up. GE down here, 14%. I mean, huge numbers, okay? The market went completely crazy. And that's because someone said something, people got encouraged, and they decided to move on that. It's a terrible reason to invest. But that's just what happens with herd mentality. Everyone jumps on board, they like something, and then there's the FOMO, the fear of missing out, okay? So you see the market, it starts, and then it dipped a little bit, and then it kind of rocketed up. And then what happens is throughout the day, people go, oh my goodness, I'm going to miss out. I better start buying. And there's different segments of people along the way, right? So you've got the early adopters that go, I'm going to get in now. And then other people go, I'm just going to watch it for a little bit and see what it does. And then it goes up and like, I'm going to jump in. Well, there's other people that were watching the watchers, right? And so those people go, well, let me see what these other people do. And then all along the line, you just see the price shoot up. And that's how you get 20, 25%, even 30% almost. You watch tomorrow. I'm pretty sure that some of those stocks that rocketed up today are going to take a significant downturn tomorrow, and people realize that they overstretched themselves and they freaked out. Now, some of them may still continue, but just by watching the market for a period of time, I can tell you some of those will pull back. It doesn't mean they'll lose all the losses, all the gains, but they might lose 5% or 10%, and if you were one of the ones that bought at the end of the day, today, thinking you're going to jump on board, and then tomorrow morning you see it start to drop, 2, 3, 4, 5, 10%, and then you freak out and sell, then you end up being one of those people that buys high and sells low when you should be buying low and selling high. And so this is just one of those just general things that you'll see in the market. But I wanted to share that because it was a crazy example today of how the market just completely rocketed up. And it was really only based on what Jay Powell said. There were some things about a vaccine and things like that, but none of this stuff is guaranteed. There were times a couple of weeks ago where they talked about some tests, and then the tests weren't so good. So when they said the tests were good, the market rocketed up, and then they, I think a day or two later, the report came out that the tests were not good or not conclusive. The market came back down. And so you can't make your decisions on investing in the stock market based on, what someone says, because there's always different interests at play. There's different reasons why people say what they say. And you have to have your own strategy. And so anyway, stock market is crazy right now. Great opportunity to make some money, great opportunity to lose lots of money. So just be careful, please. I've had people contact me and say, hey, can you help me invest? Can you take my money and show me what to do? I've resisted that. I've been thinking about doing some things, which I'll maybe share with you in the coming weeks. I still need to kind of pray about it and think about what's the best way to go. But the point is, whatever you do, just remember, I'm not giving advice. I'm not telling you what to do. I'm just saying there's opportunities out there. And so if you know what you're doing, or at least you have some courage, then it is possible to make some money at this time. It's also possible to lose a lot of money. So use wisdom, tap in the Holy Spirit, do the things that you need to do to feel at peace. But certainly it is a good time to look at what's available. The last topic I'll talk about is real estate. And look, the biggest thing that I'm seeing with real estate right now, or the biggest concern that I have, is lending. Okay, a lot of banks are not lending right now, and they're not lending for various reasons. But the three quick reasons that I'll mention is, number one is comparable sales. Okay, there's not a lot of real estate changing hands right now, and so it's difficult for banks to know how to value properties because they use comparable sales for those. So, and as we go further, like in the next 1, 2, 3, 4, 5 months, as there's even less and less sales over that time, it's going to be even harder for them to do that. Okay, so comparable sales, so banks not really sure, and that really comes into valuations. Okay, so when when you apply for a loan, they send out an assessor or an appraiser, and the appraiser says this is what we think that the house is worth. Well, they use other sales in the neighborhood as a comparable to figure out what your house is worth. Okay, so if a house that was smaller sold for this much and yours is slightly bigger, they might adjust it up. If yours is slightly smaller than the house that sold that was bigger, they'll adjust yours down. But the point is, because there's less and less of these, and there'll be even less over time, the banks are struggling to lend because of that. That's the first thing. The second thing is the banks don't know where the economy is going to go. And so if they put out money, remember, they give you a loan for 15, 30 years. They don't know whether you're going to be able to pay your loan in the next 6 to 12 months. And so because of that, they're very worried from a credit risk perspective whether or not the economy is going to continue. Because if the economy doesn't continue to improve, then a lot more people are either going to stay out of work or lose their jobs. Which brings me to the third point, which is they're worried about you. When you apply for a loan, they're worried about whether or not you're going to be able to afford to repay them. And so right now, they don't know if the economy is going to improve or where it's going to go. They don't know if the people they're lending the money to are going to be able to keep up and make the repayments. And they don't know, even if they had to sell the asset, they don't know if that property is going to be worth less than what they lent it for in the next 3, 6, 12, 24 months. And so they're very, very worried right now, because if they lend money, either you can't pay or the economy doesn't recover and the asset prices fall. And so what I'm saying is, right now, if you are looking to take out a loan for refinance purposes, my personal view is go and get it. If you can get it, if you've been looking to refinance, I'm not saying you should refinance, but if you've been sitting on your hands thinking, well, I'm waiting for rates to drop or whatever, look, they're not going to drop. This is about as low as they're going to go. I mean, they could go slightly lower, but honestly, I doubt it. I think the biggest challenge you're going to have is actually securing finance right now. So if you are able to get finance, now is the time to get it. Now is the time to refinance. If you're looking to buy a house, go and get approved, and then just sit on that approval and ask them how long that approval holds for. But I'm seeing more and more banks just not lending. And if they are, the criteria is really difficult. And those of you that were buying, after the financial crisis in 08, 09, I mean, it was hard to get a loan, and it's going to be the same now. I actually think it's going to be worse now. And so all I'm saying is, if you're looking to get a refinance to pull some money out, or get a HELOC, or any of those things, anything to do with bank funding, I would get that sooner rather than later. And by sooner, I mean like now, because banks are going to lend less and less. That will change over time, but I think we're going to go through a pretty kind of frozen period for the next 3 to 6 months, maybe longer, I don't know. But for a period of time where if you need to do something now is the time to do it, because it's going to be difficult. So anyway, hopefully we've covered a lot of ground, but I really want to just give you a general update of where things are, some of the things to be thinking about during this time. And, most importantly, if you understand what's going on and why, depending on your particular situation, you can start to position yourself the way that you think is best. So I hope that you found this interesting and beneficial for you. Please give me some feedback and let me know what topics you want me to cover in future. And I will see you in the next video.